Welcome back. In this lesson, we're going to talk about technical analysis, about three phases of every crypto movement. Consolidation, about trends, about moving averages, candlesticks and charts, breakout patterns and examples, about volume, about some other indicators, and about spread. Three phases of every crypto movement. Basically, all the cryptocurrencies, Bitcoin, Ethereum, Aave, move in cycles to the next three phases. Consolidation or range, because the price is moving sideways. Uptrends, when the price is going up, and downtrends, when the price is going down. If you zoom in, you can notice that the price is not moving in the straight lines. It has its ups and downs in all the phases. If you zoom in on the first phase, consolidation, you could notice that the price touches the same points several times. Lines that are connecting those points are very important in trading and investing, and they are called support and resistance line. Support or support level refers to the price level that a coin does not fall below for a period of time. And a coin fails to break the support level. It creates a bullish momentum, a possible buy opportunity. A support level is created because buyers enter the market whenever the asset digs to a lower price, since they are getting the same asset for the lower price. Resistance or resistance level refers to the price that a coin doesn't break out above for a period of time. And if coin fails to break the resistance level, it creates bearish momentum, a possible sell opportunity. A resistance level is created because sellers and short sellers sell or take profits whenever the coin is close to the previous highs. In the case of consolidation, you shouldn't trade or invest. You should wait for prices to go over or below. Or, if consolidation is wide, you can take advantage and trade. Consolidation is considered when a price touches the line at least 3 times. Once a coin breaks the level of support or resistance, it's starting a trend. When coin breaks out a level of resistance and starts trending higher, it's called an uptrend. When coin breaks down the level of support and starts trending lower, it's forming a downtrend. I will try to explain this a little deeper with the parable of big stores selling a chicken. For example, if you go to a big store like Walmart or Lidl and you hear chicken price for $10, nobody wants to buy it. Then the big store set a discount and they sell the chicken for $5. A lot of people are running to the store looking to buy a chicken. And then when you have a lot of people, the demand is going higher. And they raise the price to $10 again. Again, nobody wants to buy for $10. It is expensive. The store is taking a discount of $5 again, and a lot of people are coming to the store to buy. At some time, they will not have enough chicken, but they will have a lot of buyers wanted to buy chicken. Then they set the price for $15, $20, and people don't even care. They're just buying and buying. And the problem in trading and investing is that a lot of people want to buy for the most expensive price. And when it is cheap, nobody wants to buy it. This is because of people's fear. When the price goes low, people are getting scared and they don't want to buy. They usually make mistake and sell. And the price is at the highest point, people are buying because they are fearing of missing out the opportunity. And you don't want to do that. You took this course because you want to act smarter than 90% of the other people. You want to buy good things when they're cheap and sell when they're expensive. That was the reason why coins form support and resistance lines. Very often, a resistance line can become a support line, and support line can become a resistance line. Very often, when a coin breaks out and goes higher, it can back or pull back, and we test a resistance line as support. So now this line became a support line before the coin goes higher. The same goes in the support line, just vice versa. If the coin breaks down, it usually comes back and we test the support line, but now this line is a resistance line. After that, coin can continue going lower. This doesn't happen in 100% of the time, but most often this is what is happening. Here, we could see some real examples. The coin breaks out the resistance line, coming back, retesting, coming back again, and then continues going higher. This resistance line that was just broken is becoming support line later, and then coin continues going its way. Round and half numbers can also be support and resistance. There is no logical explanation of why is this happening, but usually big investors and traders do like to sell the coin before it hits the round number. So example, if it hits the 50, it usually pulls back a little, hits another time, pull back before it goes over. The same is with the round number and support line. If it goes to support line before it breaks down, it usually pulls back and then breaks down, or we could see a few of the pullbacks. The more round the number is, the stronger support or resistance is. For example, number 100 is stronger support than number 90, or number 50 is stronger support than number 60, or number 40 is stronger than 42. Number 10 is also strong support or resistance. This is very important for us when we trade and invest. We don't want to buy or sell just before the round number. It is good to wait for at least a few cents after or before the round number. So if the price is $49.99, we don't want to buy in this moment. We are waiting for price to reach 50 and at least 3 cents, and that will be a better opportunity for buying. Or for a price to go higher and then pull back, and we could buy that pullback. So how do we identify the trends? Once the coin confirms a breakout, the price is starting to go higher, forming higher highs and higher lows. It means that every high that the coin makes is higher than a previous high, and every low that the coin makes is higher than a previous low. Uptrends show that the market is bullish or optimistic. Probability is that the person who buys is going to make money. Now the question is, where do you want to buy? And here's the answer. On temporary lows or pullbacks, or breakouts of previous highs. Once the coin confirms a breakdown, the price is starting to go lower, forming lower lows and lower highs. It means that every low that coin makes is lower than a previous low, and every high that coin makes is lower than a previous high. Downtrend show that the market is bearish, pessimistic. Probability is that person who sells or sells short is going to make money. You should sell on temporary highs, pullbacks, or on a breakdowns of previous lows. As you would see in this picture, we have different types of trends. We have a long-term trend, medium-term trend, and short-term trend. If this is a 1 year of a coin, we could see that in medium trend, this coin was in a consolidation for a few months. Then for a few months, it was in an uptrend, consolidation again, then downtrend, consolidation again, and then it continued going up. So in some medium-term trend, this was an uptrend. But if we zoom in just 1 month, for example, April, We could see that in April the price was in uptrend.
But in May, the price could be in downtrend.
Every month could have some up days and down days. So these are short-term trends, medium trends, and long-term trends. It is very important for us to recognize in which trend is the coin. Once the trend is formed, price tends to move in one direction, like a river in a current. Coin prices may seem to move randomly, but they often form repeatable patterns. And you can identify these patterns. You can anticipate the direction of prices with a high degree of probability and profit immensely from it. There is a quote that says the trend is your friend. On an uptrend, you want to go long or buy the market. On the downtrend, you want to go short or sell the market. You shouldn't trade or invest against the trend. Another way to identify the trend is by using the moving averages or MA as indicator. Moving averages are calculating the moving average of coin to help smooth out the price data by creating a constantly updated average price. They can also indicate the trend direction and provide support and resistance levels. For trading and investing, commonly use our 12 and 26 EMA, exponential moving averages for short trends, and 50 and 200 SMA, simple moving averages from medium and long trends. In this picture, you could see how one of the moving averages, in this case 50 SMA, is following the price action. Once the MA is broken on the upside, the coin is starting an uptrend. Once the coin price breaks moving average on the downside, it is starting a downtrend. Every charting software that you use for trading and investing is providing moving averages for you. The benefits of moving averages are various. If you could notice, the slope of NA follows the trend, and the trend is going up, moving average is doing the same. Change in the trend occurs and the price break out or break down the moving average. The same is with the 12 and 26 ENA on the daily charts and short-term trends. Besides determining the trend, move averages act as support on an uptrend and as resistance on a downtrend. You can see here that when the price is going up, it tends to come back and test moving average as a support. And price is going down, it is coming back and testing moving average as a resistance. If the price goes too far from moving average, it tends to come back. Why is it important for us? Because on an uptrend, when you're buying, you want to buy as close as possible to MA. And the price test NA as a support and in downtrend, you want to sell short as close as possible and the price test to MA as a resistance. In this picture, you could clearly see that Bitcoin price is about all four moving averages, which means that the price is in an uptrend. I color my moving averages this way. EMA 12 with the blue color, EMA 26 with the gray, SMA 50 with the yellow, and SMA 200 purple color. You can call it in any way that you like. There are also some signals that can help us to understand the price action better. So if we see the moving average going parallel, that means that the price is in continuation. If they're going parallel in an uptrend, the coin is continuing an uptrend. If they're going parallel in a downtrend, it's continuing in downtrend. When they are crossing, that means that a possibility of new trend is on the way. For example, if smaller moving average crosses about the bigger moving average, here we have 50 and 200, this is showing the beginning of an uptrend. If 50 moving average goes below the 200 moving average, this is showing us the sign of a downtrend. All the time, smaller moving average cross about the bigger one is showing the change in trend. If the smaller moving average is going below the bigger, then it is showing us a downtrend. If we have a divergence, this means that we have faster trading trend, convergence, slower trading trend. Candlesticks and charts. The chart is a visual representation of the price history of a coin. It provides you with the context so you can understand the current price of an asset relative to previous prices. The most commonly used charts are candlestick charts. If you are looking at a daily chart that includes the last 30 days, you will see 30 candlesticks. For example, here we have a Bitcoin chart of 30 candlesticks. On a daily chart, each candlestick represents 1 day of trading, while on a mini chart, each candlestick represents 1 minute of trading. Charts can be set in almost every time frame you desire, but the most common time frames are daily charts and weekly charts for investing, and 1 hour, 15 minutes, and 5-minute charts for trading. If you take a look at the big picture again, you could notice that we have consolidation and trends. Nobody knows how long trends are going to last, but based on the price action and moving averages, we could notice a change in a trend and protect our profits. The most common way to read price movement is with candlesticks. What we see here is a candlestick. Every candlestick has 3 parts. The body, which represent the open to close range, the wick or shadow that indicates the high and low of a price movement in determined period, and the color, which reveals the direction of a market movement. Green color indicates a price increase, while red color shows a price decrease. They used to be black and white before they had computers in colors. To understand candlestick better, here's an example of how they are made on a daily basis. So if this is the open price, $8, and this is the low of the day, $3, high of the day, $30, and close, $16. This is how the candlestick would look. So this is the open price, low of the day, high of the day, and close price. Since the open price is lower than close price, this is a green candle. If the price of the candle closes lower than the open price, it will create a bearish candle or red one. Knowing the open price, close price, the lowest and the highest price of the day, you can tell the mood of the market. Is it bullish or bearish? Bullish patterns indicate that the price is likely to rise, while bearish patterns indicate that the price is likely to fall. Also, we have some candlesticks that can help us to see if the price is changing directions. While price movements sometimes appear random, at other times they form patterns that the traders and investors use for analysis or trading purposes. Many candlestick patterns are helping us to understand the price better. For example, we have hammer candle. The price was going down, and then at once it formed the hammer candle. It looked like a hammer, that's how it got the name. This is showing us the potentially changing price direction from downtrend to an uptrend. You could see here that buyers and sellers were fighting where the price is going to go, and buyers were winning. That is why the price is closed right here. We also have inverse hammer, potentially changing price direction from uptrend to downtrend. We have here buyers and sellers fighting, and here the sellers were winning. That is why the candle closed this way and formed an inverse hammer. This is potentially changing price to a downtrend. We also have indecision candles, where we have doji, spinning top, and high wave. If we have a price going up and down and then indecision candles, they're also showing us that it could be change in a trend. They can change in both direction, up or down. This is what usually happens when we have indecision candle and the price start going lower. The same if the price was going lower in indecision candle, price is going higher. We can connect candlesticks with support and resistance and moving averages, and this could help us even more to see where the price is heading. For example, we have the price going down and we have a hammer candlestick. But the hammer candlestick formed after touching the 12th EMA as a support. This is even stronger sign that the price is going to move up because we have two signs that are giving us bigger probabilities and we are more confident when trading to take these trades. The same goes for resistance and inverse hammer, just vice versa. Inside bar. When you see an inside bar, it means that there's reduced volatility in the markets. This tells you there's indecision and low volatility in the markets. For example, if the price breaks up, we can expect a big move on an upward. If the price breaks down, we can expect big move on a downward. There are also some breakout patterns that are very helping us to see where the price is headed. We have different patterns, and I'm going to talk about each and any one of them. We have symmetrical triangle, ascending and descending triangles. We have bull and bear flags, cup and handle, head and shoulders, double bottom, triple bottom, and etc. I'm going to explain this with a tennis ball example. For example, you have a tennis ball and you drop it from some heights. Tennis ball jump, then goes up, then jump again, goes up, jump again, and then less and less and less until it falls to the ground. If there was a hole, the tennis ball will just break down. The same is with the coins. We could see the selling pressure when the coin is going lower and lower every time, or the buying pressure when the coin is going upper and upper all the time. For example, here we have a symmetrical triangle. If the price is going sideways and forming a triangle, it means that here is a reduced volatility. Once the coin breaks to one of the sides, it will be a big move. If it breaks up, it will be a big move on an upward. If it breaks down, it will be a big move on a downward. With the ascending and descending triangles, we could also see a buying pressure and selling pressure. We'll see that we have buyers trying to get over some level. They're trying, but we have a lot of sellers. Then sellers are getting out. Buyers are trying. Once they break out, the price is going in a big move. The same is with the sellers. We have people try to go under some level, but we have a lot of buyers that are buying. The price is going up, coming back, going up a little less, coming back, going up, and once this point is broken, the price is going downward in the big move because we don't have any buyers anymore. This is how cup and handle are formed. We also have head and shoulders formation, double bottom, triple bottom, and some other formations. Same principle with head and shoulders. Double bottom and triple bottom we use just for investing, not for trading. I will explain these two in the next slide. Flags. You could see that it is important when the price is forming a flag, where is it coming from? Is the price coming from upward or from downward? If the price is coming from down and forming a flag, bigger probability is that the price is going to continue up. If the price is going from up and coming down, forming a flag, bigger probabilities are the flag is going to continue down. Cup and handle. This is some real example how it looks on the charts. We see that the price is making a cup and a little handle. Once it breaks out, it continues to go higher because there are no more strong sellers. You could see the buying pressure, how the buyers are getting stronger and stronger, not letting the coin to go down. Inverted cup and handle with head and shoulders. Inverted head and shoulders. Double bottom we use for investing when the price goes under the 200 moving average. And we have this pattern showing that the price is not going under and started to going up. It is likely to start making higher highs and higher lows, and that is a good opportunity for buying. The same is with the triple bottom. We see that the price went down so much and it touched the support line 3 times and start making higher highs, and this is a sign for us to buy. Volume. Trading volume is a measure of how many coins have traded in a period of time. The numbers and other indicators that use volume data are often provided with online charts. So how can volume help us? First thing that we look is a history of volume. Volume should be looked at the relative to recent history. Comparing today with volume 50 years ago might provide irrelevant data. The more recent the data sets, the more relevant they are likely to be. Second thing that we use volume for is for identifying the breakouts and false breakouts. On the initial breakout from a range or other chart pattern, a rise in volume indicates the strength in the move. Little change in volume or decline in volume on a breakout indicates a lack of interest and a higher probability for a false breakout. So you could see here, if we are anticipating the breakout and we see raise in a volume, that is a good sign. If we have a breakout and the volume is going low, this is a bad sign because we don't have a lot of people to support our breakout and for trend to continue going up. We also use volume for confirmation of a trend. The simple fact is that a price drop or rise on little volume is not a strong signal. A price drop or rise on a large volume is a stronger signal that something in a stock has fundamentally changed. For example, if we bought a coin here and the price is going higher and we see the rise in the volume, that is a good sign. But if the price is going higher and the volume is going lower, this is not a good sign and this trend is likely to fail. In a rising or falling market, we can see exhaustion moves. They are generally sharp moves in price combined with a sharp increase in volume, which signal the potential end of a trend. So if we see a big candle and big rise in volume that is at least 2 or 3 times bigger than other volume, this means that a lot of buyers came in and there are no more buyers to continue the trend. And this could be a possibility of price starting to fall. We can also use volume for price reversal. After a long price move higher or lower, if the price begins to range with little price movement and heavy volume, this might indicate that a reversal is underway and price will change direction. Other indicators. There are thousands of indicators that you can use. You can be completely successful without these indicators because price action is enough to conclude about the possibilities of future prices. I'm going to talk about 3 most powerful ones. Combining these indicators with price action can give you some better probabilities and you will be more comfortable knowing this now. First one is RSI or Relative Strength Index. The RSI is exclusively used for reversal trade. It represents if the coin is overbought or oversold. When RSI is below 30 or above 70, it indicates an intraday extreme. RSI is measured on a scale from 0 to 100, and it represents the strength of the coin. A reading of 80 to 95 indicates an extremely overbought condition, while a 5 to 20 represent an oversold condition. Any traders judge to conclusion that when RSI is the extremes, the trend cannot considerably get any more extended and could change directions. It is important to note that since RSI can remain at extremes for a long period of time, it is not reliable buy or sell indicator without additional confirmation. Stocks that are trending slowly up or down generally don't always show RSI extremes. The RSI extremes are more often combined with the parabolic moves or long trends that finally peak with one last surge. They try to use it only when RSI is below 20 or above 80. As you will see here, RSI is very low here, and this is a good sign for buying. RSI is very low here, and that was also a very good sign for buying. Then here we have RSI that is very high, around 90. So that is a good sign for selling. We had good sign for buying also right here, where the RSI is around 10 or 20. The second one is Bollinger Band. A Bollinger Band is a technical analysis tool defined by a set of trend lines offered two standard deviations, positively and negatively, away from a simple moving average, but which can be adjusted to user preferences. Bollinger Bands are developed and copied by famous technical trader John Bollinger. So Bollinger Band is actually something similar like RSI. As you will see here, when the price is overbought, it is patching the upper Bollinger Band line. When the price is oversold, it is patching the low Bollinger Band line. We use it in a way that we don't want to sell when the price is close or touching the down line, and we don't want to buy when the price is close or touching the upper line. MACD crossover. MACD is calculated using two exponential moving averages, and its value equals to the value of the shorter period, faster EMA, less the value of the longer period or slower EMA. When the MACD line crosses from below the signal line, the indicator is considered bullish. The farther below the zero line, the stronger the signal. When MACD line crosses from above the signal line, the indicator is considered bearish. The farther above the zero line, the stronger the signal. So you can see here, this is the price action, and MACD is crossing below. This is a good signal for buying. Also, they cross below. Here, it was a good signal for buying. Here, they cross above. This is a good signal for selling. Here, for some, we have crossing above. Good signal for selling. Again, MACD crosses below the price action, and this was a perfect signal for buying. We don't use these indicators alone. We can use them just to help us make our decision with the other indicators. There's price action, moving averages, or something similar. The last thing that we're going to talk in this lesson about are spreads. Before proceeding to other types of orders, let's look at the terminology mentioned above. Bid, ask, and spread. So a bid is a price a buyer of the cryptocurrency is willing to pay. Ask is the price a seller is willing to accept. Spread is the difference between these two prices. In market relations, the buyer set the price they want to get a coin for, while the seller set the price they want to sell a coin for. And here's an example. We have good news about the company. For example, Ethereum in the beginning decided to use smart contracts. So we have a big number of buyers, 8,000. But there are fewer sellers, let's say 2,000. Buyers always want to buy as good price as possible. So buyers put on bid price $10, or sellers put on ask price for $10.05. So we have a bid price which is $10 and ask price which is $10.05. That difference is called the spread. Since buyers are more desperate to buy and there are more buyers or strong buying pressure, they agree to buy for a price of $10.05 and the price goes up. That is actually how and why the price of the coins are going up. But let's say that we have bad news. Ethereum founder sold half of his coin or something similar. And we have more sellers than buyers. Buyer's bid on $10, but seller asks for $9.95. Since we have more sellers, bigger selling pressure, and they are more desperate to sell, they lower the price of coins, and that is how the coins are going down. Some exchanges have huge spreads. That is another reason to be careful when choosing an exchange. That will be it for technical analysis. I hope that you learned something new and something interesting. If you share any questions, don't hesitate to send them to support@academycom. Thank you for watching and listening, and I'll see you in the next lesson.